Good morning. It is Wednesday, September 26th. It's FOMC day, and we have the markets, at least in currency terms, awfully sideways and uncertain ahead of this event. I think the bar for a surprise is rather high, Ole, and I think the market's not really sure what to do here with the dollar. We do have some things going on in the oil markets, however. We have this big speech from Mr. Trump, which elicited a few chuckles among other reactions.
Oh, yes.
But we've seen oil pushing up into new territory the last couple of days.
Yeah, we've seen quite a decent spike over the past couple of days, but now we just seem like we're just stabilizing a bit, trading a little bit softer today. We had a speech from Trump yesterday in the United Nations that did have a bit of an impact, but also we're seeing some of the major forecasters talking about the oil prices potentially not reaching 100, potentially just settling back down again. So it's just we're having a bit of reality check there at the moment.
Great. And then the other thing going on is the euro has been trying to break higher. We've got the European yield curve finally on the move a bit here. If we look at our chart, we can see this. If I took out the December 2020 Euribor future, and you can see that we're starting to price in some rate hikes, actual rate hikes out there in the curve. It's pretty modest stuff. We're talking about more than 2 years from now, and a good 12 to 15 basis points priced in. But I think the fact that the European yield curve is on the move at all is a key signal, and it means that the bar becomes higher for the Fed and rising U.S. rates to surprise to the upside and to drive a stronger dollar. We've seen a couple of slightly weaker auctions in the U.S. Is this whole bond issuance story in the U.S., of course, the need for the U.S. to find funding outside of the country, going to start driving the dollar at some point here? And it does help the non-dollar currencies if we are seeing their yields able to track to a degree. And then on the next slide, I also show that the spread, and even out to the 10-year, the European yields, use the swaps here on the chart, versus the U.S. has actually started to crawl a little bit higher. Not nothing impressive just yet, but just the fact that it's moving up a few basis points, I think, supports the euro at the margin. So where do we stand at the FOMC meeting today? We've got inflation data pointing higher, certainly employment data pointing higher for the Fed to maintain a very hawkish stance. And I think we should expect a shift higher in the dot plot. But let's look at our dot plot here. We have the next slide where I've sort of pointed out the market is not even where the Fed is for 2019. And I think the Fed is going to adjust 2019 higher. But that may not necessarily clear this hawkish surprise bar in terms of reaction if they don't shift the dot plot further out the curve. The market's sort of willing to accept, okay, yes, the Fed is getting pretty interested in the signs of inflation being stoked here and rising, and does see more rate hikes in the near future, but not necessarily out the curve, as it is perhaps worried about the yield curve inverting too aggressively further out. So that's my take on the FOMC. I think that the bar very hard to surprise to the upside. I certainly don't see a room for a dollar surprise, although if there is one, I think that would elicit a sharper reaction in currencies and a weaker dollar.
And just from a contrarian perspective, just taking a look at some of the recent data on speculative interest, we're having a record short position held by hedge funds in the long end of the U.S. bond curve, and in the dollar, I think the dollar long is close to a 4-year high. So the market is poised for a stronger dollar and higher bond yields. Obviously, there could be a bit of a surprise down one of them.
Yeah, and it's not necessarily that both go in the same direction. We could also see yields continuing higher. We have this 3% level has been broken in the 10-year. Looking at those multi-year highs, I think it's back to 2011, if I'm not mistaken. Yep. The last time we saw yields above whatever it is, the 3.12% level at the 10-year. So we could see, a modestly hawkish message, more or less priced in. Yields continue to say high to higher, but then you're seeing yields elsewhere catching up. So you could actually see yields sustained and the dollar weaker. There's many combinations here. Yep. In other words, I just think the Fed really needs to surprise strongly to the upside, to the hawkish side, to elicit a strong dollar response. Ole, you have some charts here on oil. You talked a little bit about it earlier. Oil is the one market besides probably bonds. It's we're seeing things pretty interesting at the moment.
Absolutely, and we shouldn't discount the fact that the higher oil prices right now is once again a tax on consumers globally. And obviously, if the dollar remains as high as it is, then it's the pain of that oil rise is going to be felt sometime in the future. But just in the short term here, we've seen the market pause, as I mentioned. Trump once again yesterday yesterday went on the attack against OPEC, just basically saying it's their fault that the oil prices are being kept high. Many would probably argue that it's probably more due to his sanctions against Iran, which is at this stage potentially taking anywhere between 500,000 and 2 million barrels out of the market over the next 6 months. So that really has been a key driver. But just returning to today, on the chart, we got the weekly inventory report from the US coming out late this afternoon, and the API last night surprised the market a bit by indicating that stocks actually rose last week. EIA surveys ahead of today's number is looking for a draw, and that has created some uncertainty in the market. But looking at the three charts below, what we should be looking out for is basically Cushing, where oil inventories has been on the decline. Cushing is the delivery hub for WTI crude oil futures. So if stocks go down there, then that tends to add support to the price and vice versa. But also on the refinery demand, it's been exceptionally strong because of the high margins that the refineries are currently achieving. If the refinery demand starts to slow, that will leave more barrels in crude oil than instead of going into refined products, and that could add a bit of a drag on the price. So plenty to look out for in this afternoon. And just mention as well, there's some reports out today that Goldman's has been out basically pouring a little bit of oil on the water, just saying, hang on guys, $100 is not going to happen anytime soon. Saudi Arabia and Russia potentially has the ability to offset some of the losses from Iran, so they're still looking for oil to remain in the $70 to $80 range.
And for emerging markets, essentially we're at those old highs in crude oil prices. I saw a headline yesterday, if you take sort of a balanced look at EM currencies across the board, oil prices, because of the dollar being so strong against so many EM currencies, we're essentially at those highs. So we're talking about erosion of demand, and India apparently looking at cutting imports. So it's interesting. We seem to be meeting this level where maybe demand destruction becomes a story.
Absolutely. It's coming a lot sooner now than it did just a few years ago when we were trading averaging around $110 between 2011 and 14. Some of these countries mentioned, John, they are already now experiencing a price that level. So it's not going to take a rally to $100 before we start to see demand destruction, potentially already now. And I think there's a report out yesterday as well saying U.S. motorists are actually driving a bit less now than they did a year ago, and that's despite of the very high employment we have right now.
Right, and that price, of course, for U.S. consumers not nearly as high as it is for us here in Europe. You also got a chart here on some of the action in metals prices. What's the message we're supposed to take away here?
Well, first of all is that the industrial metals have really has seen a bit of a revival here over the past couple of weeks, and no doubt that it's coming from China, where the spending pledge and the lower taxes is starting to have an impact. We've seen copper on the move against gold. We're seeing platinum especially on the move as well. I think platinum has outperformed gold by around $50 now over the past couple of weeks. So that's showing some signs of strength. And even at silver, you can see there on the right, the ratio there is starting to move down from a historic high level around the 85 level. So these are basically indicating that some outperformance is starting to come in, because gold is basically stuck here at 1,200. It's been stuck for more than a month. Again, we got the FOMC later today. That could potentially be the trigger for.
But isn't it all about the Chinese currency with gold right now?
It is still to a certain extent. So.
And the interesting thing to me, looking at the currency space, is you see the Euro CNY going above this 8 level. And it seems to be sustaining that move. And we still have dollar CNY almost banging on that 7 level right here. So it seems to be I think there's a very interesting situation there, and I think that's one of the key things that'll play out. If that level breaks, that's one of those ones that you really have the.
That's the one we should be worried about, and that could potentially lead to some more outperformance by some of the other metals.
Right. So let's go to our calendar slide to round out today's report or today's call. We have the Czech repurchase rate. They're expected to hike 25 basis points coming up at 11 GMT. And then, of course, the big FOMC statement release at 1800. And we are expecting that rate hike. That's 99.9% priced into the market, taking the level to above 2% for the first time since, I guess back in 2007. And then we have the press conference, this being a press conference meeting, 30 minutes later. We have Trump out speaking at the UN today. This one not an address of the General Assembly, and I'm sure something potentially Iran related, so be on your toes for that, as well as Netanyahu's, we have that also set on for Thursday, Netanyahu's speech. There seems to be a bit of a focus on Iran, and this is Iranian supplies drying up has been one of the key drivers of this move above 80, so keep that on your radar as well. And then Friday, the U.S. PCE inflation data. So plenty of action. Hopefully we'll get a bit more volatility in these in FX and in other markets on the other side of tonight's FOMC meeting. Stay on your toes and stay careful out there, and we'll be back tomorrow with another edition of the morning call.